Hi, I'm Chip Rogers, and welcome to the AAHOA Educational Experience. With me today, my friends, three learned attorneys. You may have seen them before, and we are talking about the impact of banking, foreclosures, the financial crisis the nation's been through, and what you can do as a property owner to protect yourself is what we're going to focus on this week. Joining me is Timmy Hallam. She's a partner with Manat, Phelps and Phillips. Thank you for being here today.
My pleasure.
Ankar Sharma with the Sharma Law Group out of Washington, D.C. Thank you, Ankar.
Glad we could join.
And Kirtan Patel with Kumar, Prabhu, Patel, and Banerjee. Thank you so much for being here today.
Thank you, Chip.
In our previous shows, we talked about how to recognize that perhaps you need to begin working with your lender. We also talked about the lender's perspective and what's happening in the world of banking, financing, and lending. This week, I'd like to focus on maybe we've gone through the first couple of steps and it's becoming troubling. And what do you do? So let's first start with the easiest question. You're a property owner. You're in trouble, you've received those notices from the bank that either a foreclosure is imminent or that some serious action is about to happen. What can you do, first of all, to protect yourself?
Unfortunately, the best time to protect yourself is at the beginning before you sign your loan and buy your property, because the easiest way to protect yourself is to have the loan in the name of a single purpose entity that owns nothing but the hotel, and therefore the rest of your assets are not at risk. If you've signed the loan in your own name, then you can't transfer assets to somebody else without getting fair value. There is a limit to what you can do to protect yourself, and your best bet is often to try to negotiate with the lender to get off any personal liability in return for handing the keys back to the property.
How important are those original loan terms?
Those are the terms that I promise to pay and on these terms and conditions, and if I don't pay back, you take away my property. Those are the terms that we are faced with. In terms of when you are faced with that, you need to be familiar with your particular state, whether the foreclosure sale is going to be a judicial sale by process of court of law, or is it going to be a non-judicial sale. And there is a huge time difference that you can either make between a judicial versus non-judicial sale, and in between if there is a possibility to change management, change ownership, or do whatever additional steps you can take before a receiver is appointed. So those are the type of issues that you'll be addressing immediately.
But if it's a non-judicial sale so that it's going to take a long period of time, the odds are the lender is going to put in a receiver, because unless the lender puts in a receiver, the lender can't fund negative cash flow at the property. The lender is not going to be able to put in additional amounts of money, typically other than to pay taxes or insurance, and be able to get it back in front of any mechanics liens or any other claimants who may come along. So the longer the time to foreclosure, in a way, the more expensive the foreclosure, because you're going to end up with a receiver most likely.
Speaking of these loan terms, is it almost without question now that these type of loans are going to require a personal guarantee?
Well, I mean, the non-recourse market, or what do you call the CMBS market, it's coming back. We have seen some life there, at least in the hospitality industry. Looks like everybody wants to lend to hotels in today's market if there's a lending going on. But if you're dealing with the community banks, or if you're dealing with smaller banks, or personal guarantees and recourse are just a part of doing commercial real estate business.
Or if it's a construction loan, typically.
Construction loan, and that it has been that part for a long time.
So you're a property owner. You've got one property, maybe two properties, and now you're considering purchasing a third property. How do you make sure? And I think this goes back to my original question. How do you make sure that what potentially could happen to that third property doesn't impact your first two properties?
You create a single purpose entity, either a limited liability company or a corporation of some kind, or even a partnership, as long as it's not a general partnership, and you're not the general partner if it's a limited partnership. You put ownership of the new hotel property in that single purpose entity. You have the single purpose entity be the borrower under the loan and not provide any additional collateral, and hopefully not any guarantee. And if you can get away with that, then you're home free.
That's not easy.
Add to that single purpose entity, acquire the ownership under that entity, and then create a lease co, a leasing company, to lease from the owners to separate the ownership from the management.
Explain that part again, because I think that's important.
The ability of each entity to operate, own, and manage the hotel, they are the three legs of the stool on which the industry stands. So if you keep the ownership, the investor's interest separate under a separate legal entity, and that legal entity, the owner gives a lease to the leasing company, maybe with the same ownership, maybe with a little bit different ownership, then the lease co is the company that is going to be responsible for franchise fees, for mortgage payments, for tax payments, for employees. And then in addition, if there are any other restaurant leases, or they will all come under the lease co. And of course the management being the top management, whether you give it to a management company or separate it out. So that's how you distinguish your risk from being an owner to a leasing company to a management.
And Kirtan, one of the things that I think may be a misconception among property owners is that if I'm slow to make my payments, or if I can't make my payments, that the lender will just simply foreclose on my property. That's not always the case, and in fact some lenders are just going right beyond that and suing you for the personal guarantee.
Right. Well, in my state of Georgia, it is a non-judicial foreclosure state. So what would happen is after foreclosure, the bank has to go for confirmation to sue on the deficiency. But you have already signed a guarantee document saying that I'm guaranteeing the payment of the whole thing, and you don't have to go foreclose prior to coming after my guarantee. So the banks have now started taking the tack that they would bypass the confirmation process and go straight to guarantee and then come for foreclosure. It's a strategy that is being used. It is going to be tested, and we shall see what happens. At least in my state. But it does raise a very interesting issue that you touched upon here. If you have put your property in a Chapter 11 type reorganization under the bankruptcy rules, that takes care of the entity, but it still leaves you as a person who gave a personal guarantee sort of naked, unless you're going to also be able to file a chapter, any kind of bankruptcy protection.
And in my state, California, where you can do a judicial foreclosure, but that takes several years, and so typically the lender will do a non-judicial foreclosure that takes 120 days. They are being very aggressive at going after personal guarantees because it's the only way to make up for the lost value. And right. If there is a personal guarantee, the banks see no reason not to take the property, sell it for what they can get, and then go after the personal guarantor.
Would you not even say that, and I'm from a lender standpoint, that it would absolutely be on their end. It is sort of like on a fiduciary level a duty, a responsibility to right. go collect as much as they can from wherever they can on the losses that they are making.
Right, and so you cannot, in my view, realistically give a guarantee and assume that the bank is never going to come after you on it. I mean, you can give what's called the bad boy carve-out guarantees, the guarantee that you'll only be responsible if you don't pay the taxes or the insurance or you steal from the property. Those are easy, but if you give an actual payment guarantee for any amount of money, I think you have to assume that the bank is going to come after you for it.
And I think that's what Omkar was saying, that's when you're negotiating to give the property back, you better have negotiated those guarantees out, right, Omkar?
Yeah, going back to your original question, how to protect, I think each one of us pointed out that the personal guarantee portion have become a little bit more important, and that's why the carving out of the guarantee, making the guarantee expire after 2 years, or guarantee being enforceable only under certain circumstances right. Are a little bit more important than ever before. And more importantly, each state has its own rules and regulations regarding the validity and enforceability of guarantee that is sort of independent of a note and a deed of trust obligation. So I think we are getting in protection area a little bit more in the guarantee portion than the regular deed of trust and note type approach.
But I think the takeaway for the AAHOA members is if your loan is in trouble, you need somebody to carefully read all of those documents and figure out what your personal potential liability is and advise you correctly. Because you're going to have one chance to negotiate, even if the negotiation is over handing back the keys, and you want to make sure that you get whatever releases of guarantees or anything else you can as part of those negotiations. And if you've negotiated your deal and signed your deal and then discover, oh, the bank never bothered to mention that I had this personal guarantee, you're in trouble because that guarantee is still valid.
Right.
Chip, I do want to thank Asian American Hotel Owners Association, AAHOA, for providing us the opportunity to share our experiences. This is a great forum, and the educational seminars that AAHOA has organized and continues to provide is a great asset that has been brought through you to each of the AAHOA members.
On that note, very positive note, we're going to take a quick time out. And we got a lot more to talk about in this show. We'll be back right after this. Hi, I'm Chip Rogers, and welcome back to the AAHOA Educational Experience. With me today, attorneys Timmy Hallam and Ankar Sharma and Kirtan Patel. Thank you again for being with us. You know, nobody goes into business or buys their first property with the idea they're going to fail. So that's not even in your mindset when you begin down this path. But the reality is the best way to protect yourself is to assume that someday you may fail, and that's how you start from the very beginning of making sure you're protected if the worst case happens.
That's absolutely right. The best time to be careful is at the time when everybody is optimistic and thinks that things are going to turn out well. And that's the time to create your single purpose entities, to own your property so you don't put the rest of your assets at risk, to think about what you own in your own name so that you can structure your own financial house and keep it in order. So that when you present your financial picture to the bank, it's realistic, but it's not excessive. In other words, you can't shed assets because you think you're going to be in trouble and owe money to the bank. But certainly at the beginning, you can create separate entities to own different properties so that they are not what's called cross-collateralized or at risk by keeping each of them separately. And that's the best protection.
Use of mechanism known as trusts is another planning tool that you get into, whereby the ownership is separated out into for the benefit of the estate of the children or the family. And that's another way of planning in advance that the risk of loss is limited to each estate that is set up for that particular purpose.
Well, I mean, I will say that yes, these are all ways in which we can protect ourselves, but in that would happen when the markets are fairly stable. In today's market, we have seen clients asked to bring their wives to sign on the personal guarantees too, because the table has turned. Lenders are no longer chasing you. That was 2007, 2005, 2006. You were chasing lenders, and today, if you want to save your business, or if you want to save your property, or even buy a new property today, you're going to bet the whole farm, and that's generally what is happening. Now, in terms of asset planning and asset protection that we could have done, and as Timmy pointed out, should have been started in the beginning. But now we have learned that going forward, we're going to try
do better next time.
Do better next time. But today the leverage sits with the banks, and they dictate who's going to sign the guarantee. You don't sign the guarantee, you don't get a loan.
And often they may ask for additional collateral. So you think your house is protected because it's owned by your wife, but once she signs the guarantee, your house is no longer protected.
Well, in an SBA context, many times it's a requirement from a regulatory standpoint, because the whole point is that if there is not enough collateral in the business that you're buying, that additional collateral will be had from the second position in the house or whatever.
So let's say the worst has happened and that you're now being sued by the lender. What are your rights as the property owner? I mean, you've signed a loan agreement and things may not look good, but you still have your day in court. What should you do?
It depends on the state, because if you're in a state that has non-judicial foreclosure like California, there is no court. they record a notice, and 90 days later they record another notice, and then they stand on the steps of the courthouse, and in 35 seconds your property is sold to somebody else or to the bank, and you are completely out of luck. And the only way to challenge it would be for you to file a civil action and try to stop the bank from foreclosing. And in order to do that, you would have to show probability of success, which would mean you need some awfully good reasons why the bank is not within its rights to do the foreclosure. So if you can't stop the foreclosure, your only other option is to file bankruptcy, because there's an automatic stay of a foreclosure if you file bankruptcy. Everything stops dead in its tracks the day you file.
Are non-judicial foreclosures most of what's happening here, or are there still judicial foreclosures?
Depends on the state, and it's probably what, I don't know, half and half. I mean, it really depends on the state.
We can talk about, I mean, Georgia is non-judicial, whereas Florida is judicial.
Right.
In Texas, I think it only takes weeks to
Yeah.
foreclose on your property, whereas in California it takes at least 120 days.
Well, in Florida, it could take, I mean, the courts were so backed up, it could take 2 years.
So you've signed a note, you've made a guarantee on a certain amount, the property's foreclosed on, then there's that difference, the deficiency. Well, explain that so that people understand what that means.
Well, it's a very simple concept. You bought a property for $5 million. The loan on it is for, let's say, $4 million. The bank has foreclosed on it, and they were able to sell it, and the best price that they got for it was $3 million, so now you owe $1 million.
But that, again, depends on the state, because in California, if you have no personal guarantee and they do a non-judicial foreclosure, the 120-day foreclosure, which is typical, then they cannot get a deficiency judgment. You are home free. You may have tax issues, forgiveness of debt issues, but you don't have to pay on the deficiency as long as you didn't have a personal guarantee. So again, it depends on state law, and you need to understand what the law is of the state that you're in.
I agree. Sorry, one thing that Timmy, that you did mention, I think we ought to bring it out to the audience, is that when you are planning a workout with your bank, when you are negotiating, or if you have a negotiated settlement at a reduced value, remember there is something called cancellation of debt, which means that there is a tax consequence to it too. You need to have your CPA involved in it too. You may get a reduction in the principal, but you might owe a lump sum amount to IRS come next year.
Right.
That is something I think a lot of people are not aware of. They hire an attorney, they work through this process. The bank or the FDIC or whomever, they negotiate a deal, and they think they're home free, and then all of a sudden the IRS, the state of California, or whomever who imposes an income tax says, no, you had this amount of money forgiven, you owe income taxes on that.
I mean, think of it this way. If you owe $5 million and you only have to pay $4 million, it's as if somebody gave you, or you earned $1 million, and you're going to pay tax on that $1 million as if you had earned it. So you need to be very thoughtful in structuring whatever you do with the bank to try to avoid that liability. And sometimes, there are a lot of permutations. It depends on whether you actually have liability for it, et cetera. But you need careful advice before you even agree to a reduced payoff, simply because you need to understand all of the consequences.
So it's not just having somebody help you work out your loan, it's not just hiring an attorney, it's also making sure that a CPA or an accountant looks at these deals before you sign off on it, because there might be a lot more dollars that you're going to be owing that you don't even know about.
That's right, and your lender may be easygoing compared to the IRS.
Well, if you go to the right folks who have done this before, they will know that they have to bring a CPA in, or at least advise you to go get a CPA's opinion on what the spread is going to be on you, because it is a financial decision at the end of the day for you too.
On the positive side, even within US IRS, there are procedures in place to how the US IRS will forego or forgive that tax imposition because of the reduction in the amount that you have been forgiven. So there are procedures available. You just need to follow them up. If you cannot pay the US IRS and you know it, you still could approach US IRS and ask for a forgiveness even on the federal taxes.
a word that we've used here a few times, which is an ugly word, painful word, but maybe the best word at some point, bankruptcy. When is that a viable option?
When there are no other options and when you think it's actually going to get you some benefit. I mean, what a bankruptcy buys you at the end of the day is a lot of expense and a lot of headache, but time. And if a little bit of time, because if it may not be a lot of time depending on where you file and all the issues, but if a little bit of time will be a benefit to you, bankruptcy may be the right choice, although it's going to taint your credit going forward for quite a period of time. But if you can negotiate handing back the keys, that may be better than a bankruptcy because at least there's less taint if you only hand back the keys.
Chip, I'm going to let our bankruptcy expert Caitlin handle this one. Just before that, if there is a concept of being judgment proof in your state, perhaps that's another option for at least an individual to look into being judgment proof or filing for bankruptcy.
Yeah, well, I mean, from our standpoint, in a non-judicial foreclosure state, things move very quickly. In Georgia, you can you just give 4 weeks worth of notice and you can foreclose. So between 45, 60 days, you can actually foreclose. And many times when there is no other option left, you go buy yourself time. Bankruptcies are very expensive. We generally recommend it only if we feel that we can provide a plan that could succeed. 95% of bankruptcies filed under Chapter 11 reorg end up in liquidation at the end of the day. 5% have a chance of success. It's going to be interesting to see this time around after this crisis how the numbers stack up, only because I think this time it's different. Some people will just have to file bankruptcy just to protect their property, and not because they had a plan or anything, just to protect it as best as they could. So we shall see, but I think the odds are stacked against you when you get into bankruptcy.
Well,
Sometimes.
I hate to end on that note, but the clock stops for nobody. We are out of time, and I really want to thank you for being here. I think our viewers certainly gained a lot of information out of this, some information that had they come to your office directly would have cost them a lot of money. So we're saving them money, as always. I want to thank my guest, Kirtan Patel, for being with us, Ankar Sharma, and Timmy Hallam. It's been quite an experience, and thank you for all that you've shared with our viewers.
And thank you.
You bet. If you have any questions, feel free to contact me. You can reach me email, chip@ahoa.com. That's CHIP@AAHOA.com. Thanks for being with us, and we'll see you again next time.